Legally untouchable, navigating the dark side of tax laws. The intricate dynamics of taxation, particularly in relation to affluent individuals, have long been a subject of fascination and scrutiny. This video aims to explore the nuanced world of taxation, shedding light on the strategies employed by billionaires to legally minimize their tax contributions. Special attention will be given to the distinct tax scenarios in India and the United States, elucidating the disparities and legal intricacies that enable the wealthiest individuals to navigate the tax landscape. The Indian tax landscape. Data from the Government of India paints a revealing picture. A mere 6.25% of the colossal population of 1.32 billion people pays income tax. This statistic prompts questions about the efficiency of India's tax collection system. In contrast, the United States boasts a significantly higher percentage of taxpayers, standing at 45%. This stark contrast invites an examination of the underlying reasons and legal frameworks that allow for such disparities in tax compliance. One of the most surprising revelations is that regardless of the country, be it the United States, India, or any other, many billionaires pay minimal or no taxes to their respective governments. Figures such as Jeff Bezos, Elon Musk, Donald Trump, and Larry Page, despite amassing vast fortunes, seem to evade significant tax obligations legally. This raises a fundamental question. How is it that individuals in the upper echelons of wealth can legally sidestep substantial contributions to the government? And the enigma of $1 salaries. A peculiar trend among top CEOs, regardless of their billionaire status, is the acceptance of symbolic $1 salaries. This prompts us to ponder how these influential figures sustain their lavish lifestyles while seemingly foregoing substantial incomes. The incongruity of these individuals, who should logically be at the forefront of substantial tax contributions, paying minimal or no taxes, raises eyebrows and warrants a closer examination. Understanding the intricacies of taxation requires an exploration of how governments collect revenue through taxes. Generally, governments employ two main types of taxes: direct and indirect. Direct taxes include income tax, capital gains tax, and corporate tax. On the other hand, indirect taxes, paid by common citizens, are exemplified by the Goods and Services Tax, GST, in India. Disparities in taxation. Despite a seemingly straightforward tax structure, disparities arise in the amounts paid by individuals with similar incomes. An illustrative example involves two individuals, Raj and Amit, both earning a yearly income of 1 crore rupees. Despite their comparable earnings, Raj, with a high-paying job, may find himself paying 20 to 25 lakhs in taxes, while Amit, a businessman, might legally pay 0 taxes. This disparity challenges conventional notions of fair taxation and underscores the need to scrutinize the underlying principles. Tax saving versus tax evasion. It is essential to distinguish between tax saving and tax evasion. Tax saving involves legitimate methods to reduce tax liability through legal avenues, whereas tax evasion encompasses illicit activities aimed at avoiding tax payments. The crux lies in taxable income, the income on which the government can lawfully impose taxes. The wealthy's legal strategies. Affluent individuals employ various legal methods to minimize their taxable income. These include undervaluing assets, leveraging stock compensation, and strategically utilizing charitable donations. While these practices operate within the bounds of the law, they exploit existing loopholes in tax systems, prompting a re-evaluation of tax regulations. Undervaluation of assets. One method employed by the wealthy involves deflating the value of their assets by distributing ownership among multiple stakeholders. For instance, a billionaire like Bambani may own a valuable property or stocks through a limited liability company, LLC, with various stakeholders. The dilution of power makes it challenging to sell the assets at their actual market value, leading to an on-paper devaluation of the asset. Stock compensation. Many CEOs, like Steve Jobs from 1997 to 2011, opt for nominal salaries such as $1, but receive substantial stock compensation. This approach allows companies to consider stock compensation as a non-cash expense, reducing the company's profits and saving on taxes. Additionally, billionaires can use their stocks as collateral for loans, effectively converting their wealth into a financial instrument without incurring tax liabilities. Charitable donations. In both the United States and India, tax laws provide incentives for charitable donations. Section 80G of India's Income Tax Act exempts donated amounts from taxation, encouraging businessmen to establish charitable trusts and organizations. By donating to these entities, billionaires can deduct the donated sum from their taxable income, effectively reducing their overall tax liability. Government's role in creating opportunities. While it may seem counterintuitive, governments play a significant role in creating opportunities for the wealthy to minimize tax payments. Tax rules, laden with loopholes, inadvertently incentivize the wealthy to employ legal strategies to reduce their taxable income. This phenomenon raises pertinent questions about the motivations behind such rules and their implications for overall tax revenue. Business owners and tax exemptions. Governments often grant tax exemptions to business owners, recognizing their role in job creation and economic stimulation. By creating opportunities for employment, businesses contribute both directly and indirectly to tax revenue. This recognition prompts governments to provide tax exemptions to businesses, ensuring a delicate balance between economic growth and tax collection. Governments, inadvertently or otherwise, create opportunities for the wealthy to exploit existing loopholes and minimize tax contributions. As we navigate the intricate dance between the rich and tax regulations, the call for continuous evaluation and reform becomes increasingly imperative. The future of taxation rests on our ability to address these complexities, ensuring a fair and equitable system that serves the interests of all stakeholders in the global economic landscape.